studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
When planning compensation for a corporate owner-manager, one of the biggest decisions is whether to receive salary or dividends. That decision doesn't just affect income tax, it also determines whether the owner contributes to the Canada Pension Plan, or CPP. Many business owners automatically assume that contributing to CPP is always the best choice. However, some tax advisors consider an alternative strategy. Instead of paying salary and making CPP contributions, the owner receives dividends and directs similar amounts of money into a tax-free savings account, or TFSA. This slide introduces those two different retirement strategies. Let's begin with the first path shown on the left. If the corporation pays the owner a salary, CPP contributions become mandatory. Both the employee and the corporation contribute. Over time, these contributions build eligibility for future CPP retirement benefits. It's important to understand how those contributions work. The employee portion directly helps build the individual's CPP pension. The employer portion, however, is different. Although the corporation must pay it, that additional contribution does not directly increase the employee's personal CPP entitlement. From the corporation's perspective, it functions as a payroll cost. Now look at the second path. Instead of paying salary, the corporation pays dividends. Since dividends are not pensionable earnings, no CPP contributions are required. The business owner can then choose to invest similar amounts into a TFSA, creating a personally controlled investment portfolio rather than relying entirely on a government pension. This is why the comparison on the right side of the slide is so important. On one side, money flows into CPP and eventually produces a government pension. On the other side, money flows into a TFSA and builds a personal investment account that belongs entirely to the owner. Notice that this isn't a question of whether CPP is good or bad. CPP provides valuable benefits, including a guaranteed lifetime pension that is backed by the government. The real planning question is whether directing comparable dollars into a TFSA might create greater flexibility for certain clients. Some business owners value having complete control over their retirement investments. Others prefer the security and predictability of a government pension. Neither approach is automatically better. The right choice depends on the client's goals, financial situation, and overall retirement plan. The thought bubble at the bottom of the slide captures the mindset that every tax advisor should encourage. Rather than asking, which strategy is best for everyone? The better question is, which strategy best fits this client's objectives? Throughout this section, we'll compare these two approaches in greater detail. We'll see how a TFSA can function like a private pension, examine its tax advantages, and also discuss the important situations where continuing to contribute to CPP may still be the wiser choice. The key takeaway from this slide is that compensation planning involves more than simply deciding between salary and dividends. It also shapes how a business owner builds retirement income and how much flexibility they will have in the future. In the previous slide, we introduced the idea that some owner-managers choose to build retirement savings through a tax-free savings account instead of making CPP contributions. Now let's see how a TFSA can function much like a private pension. The process begins at the top of the slide. Each year, the owner contributes money to their TFSA. Those contributions are invested in assets such as stocks, mutual funds, or exchange-traded funds. Over time, the investments grow, and because they are held inside a TFSA, all of that growth is completely tax-free. In our example, Years of regular contributions have grown the TFSA to a value of $300,000. If the owner withdraws approximately 4% each year, the account can provide around $12,000 of annual retirement income. Now compare that income with an equivalent CPP pension. If a retiree receives $12,000 from CPP, that entire amount is taxable income. It must be reported on the tax return and can increase the person's overall taxable income. By contrast, if the retiree withdraws $12,000 from a TFSA, the entire withdrawal is tax-free. It is not included in taxable income, and no income tax is payable on that withdrawal. This difference creates several planning advantages. As shown on the right side of the slide, TFSA withdrawals do not affect the old age security clawback calculation. They also do not increase income for most income-tested government benefits, and they do not push the retiree into a higher marginal tax bracket. This gives the retiree far more flexibility in deciding how much income to withdraw each year. They can access their TFSA savings without worrying that those withdrawals will increase their tax bill or reduce their government benefits. The bottom section of the slide reminds us that a TFSA is only one part of a complete investment strategy. Once the available TFSA contribution room has been fully used, additional savings can continue in a non-registered investment account. Different types of investment income receive different tax treatment. Capital gains are only partially taxable. Eligible dividends often receive preferential tax treatment, while interest income is generally fully taxable. This allows a tax advisor to build a diversified investment strategy that balances tax efficiency with the client's financial goals. The key lesson from this slide is not simply that TFSAs provide tax-free withdrawals. The real advantage is flexibility. The retiree decides when and how much money to withdraw, and those withdrawals generally do not affect their taxable income or their government benefits. For many corporate owner-managers, that flexibility can become an important part of a long-term retirement plan. However, before concluding that a TFSA is always the better choice, we also need to consider what CPP provides. CPP offers guaranteed lifetime income, inflation protection, and valuable disability benefits that a TFSA cannot automatically replace. In the next slide, we'll compare the strengths of both approaches and learn how professional tax advisors determine which strategy is the better fit for each individual client. We've now explored both retirement strategies individually. The final step is understanding when each approach makes the most sense. The goal isn't to prove that one strategy is always better than the other. Instead, it's to match the strategy to the client's specific circumstances. Let's begin with the left side of the slide. The Canada Pension Plan offers several important advantages that are difficult to replicate through personal investing alone. First, it provides guaranteed lifetime income. No matter how long you live, CPP continues paying benefits for life. Second, CPP benefits are adjusted for inflation, helping retirees maintain their purchasing power over time. Third, CPP provides valuable disability benefits for eligible contributors who become disabled before retirement. These benefits can provide financial protection during a person's working years. Finally, CPP removes investment risk from the individual. The retiree doesn't need to decide where to invest, worry about stock market fluctuations, or manage a retirement portfolio. The government administers the plan and guarantees the pension according to the program's rules. Now let's compare that with the TFSA. A TFSA offers a completely different set of strengths. Withdrawals are entirely tax-free, allowing retirees to access their savings without increasing taxable income. Because TFSA withdrawals are not included in taxable income, they generally do not trigger old age security clawbacks. or affect most income-tested government benefits. Another major advantage is investment control. The owner decides how the money is invested, when contributions are made, and when withdrawals occur. There is also estate planning flexibility, because unused TFSA assets remain part of the owner's estate and can often be transferred efficiently to beneficiaries. And, of course, all investment growth inside the TFSA remains tax-free. Neither list of advantages is objectively better. They simply serve different purposes. That's why professional tax advisors use the decision framework shown in the center of the slide. They begin by asking several practical questions. What level of retirement income is the client expecting? Does the client value guaranteed lifetime income? Or are they comfortable managing their own investments? How much investment risk are they willing to accept? Would disability protection provided through CPP be important? Or does the client place greater value on flexibility, tax-free withdrawals, and control over their retirement assets? The answers to these questions help determine which strategy is more appropriate for some clients, especially those who value security and guaranteed income. Continuing to contribute to CPP may be the better choice. For others, particularly disciplined investors who already expect substantial retirement income and want greater flexibility, directing funds toward a TFSA may produce a more tax-efficient retirement plan. The retirement journey illustrated across the bottom of the slide summarizes the entire process. Everything begins with a corporation. The owner chooses whether to receive salary or dividends. That compensation decision determines whether CPP contributions are made or whether more funds are available for TFSA investing. Those choices eventually shape retirement income and ultimately influence the client's lifetime tax burden. This brings us to the most important lesson of this section. Professional tax planning is rarely about finding one perfect strategy for everyone. Instead, it is about understanding the client's goals, financial circumstances, risk tolerance, retirement expectations, and personal preferences. Some clients sleep better knowing they have a guaranteed government pension. Others prefer the flexibility and tax advantages of building their own retirement portfolio through a TFSA. As tax advisors, our role is not to recommend the same solution to every client. Our role is to evaluate all the available options and recommend the combination that provides the greatest long-term benefit. The best compensation strategy is the one that helps the client achieve financial security while paying the lowest reasonable amount of tax over their lifetime.